This is an Uncovered Japan Company research report on JARMeC, ticker 6039. Japan Animal Referral Medical Center is the country's only listed pure-play secondary care veterinary hospital. Local vets refer difficult cases for CT, MRI, oncology, and specialist surgery. We will examine its referral network moat, record profitability, expansion plan, and the valuation risk investors must weigh. The report is dated June 3, 2026, with market data reference to May 11th. JARMeC earned an 18.5% return on equity and an 18.6% operating margin in fiscal 2026, supported by 4,779 partner clinics. The offset is valuation. Forward earnings trade around 21.5 to 23.5 times, with thin liquidity typical of a roughly 19 billion yen small cap. Think of JARMeC as a teaching hospital for pets. A neighborhood clinic handles routine care, but sends a dog with a spinal tumor or a cat needing advanced imaging to JARMeC. The company concentrates roughly 100 veterinarians, CT and MRI equipment, specialist surgery, inpatient care, and home care support. Crucially, it returns the patient to the original vet, making local clinics customers and referral partners rather than competitors. Secondary care hospitals generated about 73% of fiscal 2026 revenue and grew 19.2%. Home care equipment, especially oxygen chambers used after treatment, added roughly 16%. Imaging diagnostics and teleradiology contributed another 10%. Together, these businesses cover the patient journey before referral, during specialist treatment, and after discharge, deepening both clinic and pet owner relationships. The Moat starts with a referral network that cannot be purchased overnight. Each clinic relationship is earned through good outcomes, clear communication, and a reliable handback. Case volume then lets JARMeC concentrate specialists and expensive equipment in a few sites. Better clinical capability attracts more referrals, higher utilization funds further investment, and the loop reinforces itself. The binding resource is scarce specialist talent, not physical equipment. Revenue rose from about 3 billion yen in fiscal 2022 to 6.2 billion in fiscal 2026, a compound rate near 20%. Operating profit increased faster, from 440 million yen to 1.15 billion, or roughly 27% compounded. The fiscal 2026 profit jump reflected higher case volume, price increases, fuller hospital utilization, and better productivity. Operating margin fell to 11.6% in fiscal 2024, then recovered to a record 18.6% as pricing and utilization improved. Return on equity more than doubled from 8.9% to 18.5% by fiscal 2026. The equity ratio declined to 43.1% as the company invested for growth. So the next phase must convert that capital into productive hospital capacity. Operating cash flow held near 1.4 billion yen in fiscal 2026, but free cash flow fell to negative 1.09 billion. The report attributes this to deliberate land and equipment spending for expansion, rather than operating deterioration. That investment is financeable, but it raises execution risk. New hospitals impose buildings, machines, and staffing costs before referral volume and utilization catch up. Only 36.6% of Japan's first-line clinics are currently partner clinics, leaving more than 6 in 10 outside the network. New Nagoya and Fukuoka hospitals can activate regional catchments that Kawasaki cannot serve efficiently. AI-assisted radiology and a new electronic medical record may improve throughput. But the thesis turns on hiring. An MRI can be purchased quickly, while a specialist veterinary surgeon cannot. The valuation is the clearest restraint. The report estimates forward earnings at roughly 21.5 to 23.5 times. JARMeC's historical midpoint was around 17 times, and its prior high near 21. The re-rating follows record margins and 2 strong years. But today's price already assumes that high growth and high returns persist. A hiring delay or slower hospital ramp could pressure both earnings and the multiple. These are the report author's assumption scenarios, not price targets or investment advice. From the report's reference price of 1,327 yen, the 3-year bear case is about 34% lower, the base case about 39% higher, and the bull case about 126% higher. The range reflects the interaction between new hospital execution and valuation. Specialist hiring, utilization, margins, and management's recurring guidance upgrades are the most useful indicators. To conclude, JARMeC combines a difficult-to-replicate referral network, scarce specialist capability, strong returns, and a large geographic opportunity. Its next growth nodes could extend that franchise, while AI and imaging services improve productivity. The trade-offs are equally clear. Free cash flow is funding expansion, specialist hiring is the bottleneck, and the valuation leaves less room for disappointment. For the complete evidence, assumptions, and source detail, continue with Uncover Japan's free deep dives. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.